Every day you leave your cash sitting in a standard savings account, inflation is quietly eroding its purchasing power. Over a few years, the math guarantees that your money will buy less. On the other side, looking at the 2026 stock market feels like staring into a chaotic void. Prices gap up and down, algorithmic trading drives wild swings, and the barrier to entry seems impossibly high to navigate. That contrast creates a trap. Beginners think their main goal is to somehow identify and pick winning stocks out of that daily chaos. In reality, the goal is to select a reliable wealth-building system. If you try to chase market trends, you are likely to burn out or make an emotional error. Choosing a system that naturally fits your daily routine and lifestyle constraints is a reliable way to avoid failure and stay invested. All investing comes down to a strict trade-off. To secure a return on your capital, you have to pay with your personal time, or you have to pay with your money by handing over fees. This blank quadrant chart maps exactly how financial institutions view this trade-off. On the bottom axis, we measure the time required to manage the strategy. On the side axis, we measure the financial knowledge required to execute it. When you look at active strategies, like day trading or picking individual stocks, they require massive amounts of constant research and daily screen time. They sit entirely in the high-time, high-knowledge zone. For a beginner, trying to beat the market manually is a mathematical losing game. Professional bankers and algorithms will take the other side of your trades, which is why we completely eliminate this top right section from your options. The reliable vehicles live entirely in the bottom half. These are proven, automated, long-term systems that demand far less of your daily effort. Your long-term success relies on identifying the exact intersection of convenience and control that you will actually stick with year after year. The absolute lowest friction choice available is the Target Date Index Fund. The setup takes a few minutes. You take 100% of your investment capital and place it into a single pre-mixed fund that matches the year you plan to retire. This line graph shows exactly how the fund operates internally. As the timeline moves closer to your retirement year, the portfolio automatically shifts its holdings, selling off volatile stocks and buying stable bonds to reduce your risk. A professional manager handles every adjustment, every rebalancing act, and every risk reduction, completely in the background as you age. The catch is that you surrender the steering wheel. If you decide you want to retire a decade early, or if you prefer to keep a highly aggressive, stock-heavy portfolio well into your 60s, you cannot adjust the fund's timeline. The Target Date Fund offers the ultimate hands-off convenience, and in exchange, you completely give up control over how your capital grows. If you want a middle ground, you look to a robo-advisor platform like Wealthfront or Betterment. To use the platform, you agree to an annual management fee. It is typically around 0.25%, deducted directly from your total assets. For that price, the software performs advanced institutional-level tasks. It automatically harvests tax losses to lower your IRS bill and builds custom portfolio weightings, all without you touching a spreadsheet. But take a look at these two compounding interest curves projected over a 30-year timeline. The lower curve represents a portfolio carrying that 0.25% fee. By year 30, a massive gap opens up between the two lines. That tiny percentage is called fee drag. Because the fee is taken out every year, you lose that money, plus the decades of compounding growth that money would have generated. For an average investor, it easily equals tens of thousands of dollars. A robo-advisor is a luxury service. You are sacrificing your long-term compounding capital to buy short-term mathematical convenience. The option that maximizes your control is the DIY 3-Fund Exchange-Traded Fund, or ETF, portfolio. This requires manual labor. You log in to your brokerage, purchase the specific index funds yourself, and run the math every year to maintain your exact asset allocation. The financial reward is immense. You strip away the management fees entirely, meaning 100% of your compounding returns stay in your own account. The threat here isn't the math, it's you. When a market downturn hits and your portfolio drops 30%, you are sitting alone in front of a glaring red screen. To succeed, you have to log in during a panic, force yourself to execute trades, and manually buy more stocks while the broader market crashes. The DIY approach offers the highest theoretical returns, but it strips away the psychological safety net, leaving you vulnerable to your own human error. Financial complexity is often used as a sales tactic to justify high fees. True wealth strategies rely on simplicity. This decision tree maps the choice, starting with one clear question. Do you want to log in and manage your money manually? If the answer is an immediate no, you follow the branch down to the target date fund. This is the exact match for a time-poor novice who wants zero friction. If the answer is no, but you still want tax optimization, the branch leads to the robo-advisor. That fits the anxious saver who is willing to pay a fee to keep a psychological safety net. If you answer yes, you land on the DIY ETF portfolio. This is for the aspiring optimizer who has the discipline to learn the math and execute the trades. Searching for the mathematically superior strategy is a distraction. Your optimal path relies entirely on an honest assessment of your free time and your behavioral flaws. The most dangerous mistake a beginner can make is suffering from analysis paralysis, endlessly researching options and keeping their cash uninvested. The difference in return between these three investment systems is measured in fractions of a percent. The cost of holding uninvested cash is a massive guaranteed loss. Time spent in the market dictates your growth. Decades of compounding interest will always outweigh the technical perfection of the vehicle you choose. The perfect investment system does not exist in a vacuum. It is simply the one you can stick to, consistently, for the next 30 years.